The most common objection I've gotten from my recent videos is that real estate is cyclical, we've been here before, and this is just another down cycle. And on the surface, that's a fair point, but what we're experiencing now is structural. Interest rates, operating costs, demographics, technology, and even how we think about storing value have all fundamentally shifted. Today, I'm going to cover why you need to approach this market through a structural lens and not a cyclical one. We can all agree we're in a down cycle. Values have fallen, foreclosures have risen, bases are getting reset. Lenders have pulled back, development slowed. Each of them will eventually ease. These are the cyclical forces that we're accustomed to in the real estate business. But layered on top of that is a structural regime shift, and that's what makes this cycle different. So, what are some of those structural forces taking place? Well, first, demand has shifted. You have flexible footprints, shorter lease terms, remote work, experience driven retail, housing preferences, and decentralized corporate footprints. These are all things that don't revert back easily. How about costs are permanently higher, whether it's taxes, insurance, labor, utilities, maintenance, they're all rising faster than our 3 to 4% rent bumps. So that's a margin squeeze that does not go away with lower interest rates. How about the aging inventory? You can lower price, but you can't change clear heights, power loads, floor plates, window lines, ventilation, or accessibility, all without massive reinvestment. The monetary premium is leaking out of real estate and being absorbed by Bitcoin. Like it or not, that is a fact. You also have new capital innovations, things like 24/7 payment rails, fractional ownerships, Bitcoin treasuries, dual collateralized loans, and competing products that actually increase the hurdle rate. So I want to touch on interest rates here for a second. Let's give the Fed the benefit of the doubt and say they actually get back to their 2% inflation target. The Fed funds rate settles in the 2% range and long-term treasuries anchor in that 3 to 4% range. So that means that stabilized property financing is living in the 5 to 7% range going forward. So when cap rates have to move from 4 to 8%, that's a 50% decline in value, assuming that your NOI is flat. Now you have to add on your operating expenses that are outpacing your rent growth. And now you start to see why this isn't just another swing of the pendulum. This is a complete recalibration of value. For 15 years, markets have been conditioned to believe that the Fed's not going to allow another real down cycle to occur. The first sign of weakness, they're going to patch over it and kick the can. Now, that's an entirely separate discussion, but let's not forget that suppressing cycles only builds fragility in the system. And when the reset ultimately comes, it hits that much harder. But here's the bigger point I want to make. Even if the Fed does step in again, their only lever is interest rates. That doesn't reverse demographics. It doesn't stop AI or automation from reshaping the workplace or society for that matter. It doesn't erase the mobility of labor or the rise of Bitcoin as a superior store of value. Those forces are all structural and they're well outside of the Fed's control. So ask yourself this, if rates drop 200 basis points tomorrow, would your B property with high CapEx and 65% occupancy suddenly work? If the answer is no, that's not a cycle problem. That's a utility problem. Or how about this? If the store of value premium were to be stripped away, who's the marginal buyer and at what yield? If the answer is only at much higher cap rates, then that value is already, it's no longer there. So let me be clear. This reset is not just about Bitcoin. Yes, Bitcoin is a major piece of the puzzle, but when you zoom out and you see the other macro forces taking shape all at the same time, things like aging demographics, AI, robotics, and automation, the mobility of labor, different generational expectations, a long-term debt cycle concluding and a new monetary regime emerging, you now overlay all of this onto the real estate markets and you come to the conclusion rather quickly that much of the inventory is functionally and economically obsolete for what's to come. So again, this is a structural disconnect, not a cyclical one. So what does all of this mean if you're an active participant in this market? Well, for one, if you're not buying assets out of bankruptcy for pennies on the dollar or well below replacement costs, I don't care how great the asset looks on paper, you will struggle in the years ahead. Now, let's say you can acquire an asset at an attractive basis. You get a quality asset, great location at an attractive basis. That is just the first filter, and you have a path forward. But from there, you now need to implement the strategy that I've been talking about across this series. Things like Bitcoin treasuries, dual collateralized loans, energy efficiency, tech integration, and you need to figure out how to keep your renovation and improvement costs down through things like modular improvements. If you don't do this, even the best bought properties will struggle to exceed newly established benchmarks in the years ahead. The truth is, I don't know how long this reset lasts. It could be years, or it could define an entire generation of real estate ownership. What I do know is the only safe way forward is to assume it's extended and to prepare accordingly. If you're going to survive what's coming, you need discipline in what you buy and innovation in how you operate it. As always, I want your feedback. Drop your thoughts in the comments or DM me. I'm also going to ask you to share this. Share this with your team, share it with your clients, share it with your investment partners. I need your help spreading the word. Thanks for stopping by, and I'll see you here next time.